Yeah, look, and just recently I've had a look at the valuation dispersion between value and growth in terms of book multiples. And what's interesting is that the multiples for growth stocks have now increased to a level not seen since 2000 during the dotcom boom. And against that backdrop, valuation dispersion, or the price to book dispersion between growth and value, has increased to a level that's without precedent. It's now even at a more extreme level than what it was back in 2000 during the peak of the dotcom boom. So stocks such as CSL, Ramsay Healthcare, Domino's Pizza, those kind of growthy stocks, in aggregate, they're trading at far higher multiples than they have in the past. What's interesting though, this pattern's also evident in the United States. In the last couple of years, there's been this multiple expansion concentrated in the growth sector of the market. But in the United States, the key difference there is that there's actually been, broadly speaking, a commensurate increase or expansion in expected profitability for those stocks, which would justify multiple expansion. In Australia, that hasn't been the case. In fact, there hasn't been any commensurate increase in the expected profitability for these growth stocks at all. So it's been purely a case of multiple expansion. So the risk going forward is that some of these stocks kind of yield lower expected returns because the key driver of that multiple expansion has to be lower expected returns. So stocks, in particularly the stocks that in the last 2 years have experienced the largest multiple expansion with very little earnings expansion, have been stocks like Mayne Pharma, Domino's Pizza, as well as Northern Star, GUD Holdings, Technology One, Corporate Travel Management, and Cochlear. So I think kind of what we're seeing in the marketplace in the last couple of months in terms of a rotation has been a rotation away from some of those kind of highly priced names. Not all of them, but across the board, I think the risk for these growth stocks is that you see some evidence of valuation compression. I think the challenge from a market timing perspective is to identify what are the key catalysts that are going to cause a turnaround. And we're starting to see some evidence of the markets reacting or treating these growth stocks a bit more harshly in recent times. But it remains to be seen whether that's going to continue or not, or there might be another catalyst in due course. But overall, I'd certainly certainly prefer to have an underweight in some of those highly priced growth names at the moment. At some stage, I'd expect the valuation dispersion to narrow.